Hi, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update today about the economy and the markets. The Federal Reserve Open Market Committee met yesterday. Bernanke had his first ever public interview process through the press. And it was kind of an interesting watch. While truly I didn't learn anything from what he had to say, these were things that were already baked in a cake, and a lot of spin is basically put on really inflationary environment and also the economy. Some of the things that he did say, which I think should be apparent to every investor out there, is the economy really is generally improving at an extremely weak pace, which is essentially what the Fed said. Inflation is on the rise, although they think it's a temporary scenario, if I kind of want to reword kind of what they said just a little bit. But essentially they think it's kind of a temporary scenario, will come back to normal, and they don't see it getting out of control. Now, I don't think inflation is temporary at all. In fact, I think there are major shifts over the extended period of time that you're going to see in the world economy. As emerging market economies continue to expand, I believe investors are going to see more and more pressure and more inflationary environment. Not Jimmy Carter day inflation, but inflation much higher than the Fed's going to want at about 2.5% to 3%. I think we're going to be headed for 4 to 6% inflation on a long-term trajectory. And I believe a lot of that's going to do because of the emerging market economies emerging and really wanting a better lifestyle, eating better foods, wanting cars, gasoline, things of that nature, just like America has enjoyed for many decades. So what's going to happen is going to be a natural supply and demand factor, not from printing money. I continue to like commodities quite a bit within our portfolio, and we do own a sizable position in that for our clients. We have enjoyed the run-up in the commodity prices as inflation has come up a little bit, but generally speaking, I still like commodities. One of the areas that we are looking at adding a position in right now is actual gold. I think we have a potential now, because of the printing presses of the U.S. and because the dollar is getting weaker and weaker, the Federal Reserve is allowing this to happen. I think this is going to continue to keep our economy kind of chugging along, even though it's at the slowest pace probably of any recovery we've ever seen. As an investor, I think you really need to make sure you understand the headwinds that are ahead of us right now. And I was talking to one of my analyst people yesterday. We had a little meeting on this, and one of the things that I brought up is the U.S. economy is laden in debt. Our growth is the slowest really recovery we've ever seen coming out of a recession. The interest rates are basically at zero, meaning we have very little wiggle room if any disaster was to happen. If we had another terrorist attack, we don't have really any money left in our arsenal, or bolts left in our arsenal, basically to reload and help kind of prop the economy more. So I really am a little bit cautious here as I look at the U.S. economy, not the world economy, especially a lot of the emerging markets like India and China and Brazil and things of that nature, where I think they're in a much more stable footing. I think the next decade, the big money is really going to be made in small, mid-cap, not only in the U.S., but also more so in the international marketplace and on the emerging markets. I think the bigger growth aspect of a portfolio, one of the areas you're going to look for growth because of inflation, is going to be commodities, oils, grains, things of that nature that really are use assets that people are going to need, and because the supply and demand factor is going to be in there. So the bottom line, Bernanke really didn't tell me anything that I wasn't expecting him to tell, other than they try and soften the tone not to get people too nervous. Job recovery is going to be slow at best. Unemployment is stubbornly high. Wages really haven't gone up for most people in the last 5 to 10 years, really at all. Even if you compare that to inflationary purposes, you're behind the 8 ball. And so if you kind of look at that, the U.S. economy, generally speaking, is getting to be at the mature stages of a fully developed nation. And you're seeing that the same signs we saw that Japan saw 20 years ago. So what that means is if you are primarily a U.S. investor, if you're investing in primarily U.S. stocks and bonds, especially on the large cap side, I think you're really going to be in for a hard time ahead. I think you have to realize that that is not the only asset class to invest in, or two asset classes, that you need to shake it up. You need to make changes to your portfolio, and that portfolio needs to be actively managed. You're going to have to make changes more often than you once did. We're not in a secular up market like we were from 82 to 2000. We're really in a secular decline, especially in the U.S. economy, from 2000 till now, and I think we have another 6 to 8 years of that, where you're going to see lower lows You'll see these peaks and valleys, but it's not a buy and hold investment environment at all. It's going to be somewhat more of a riding the trend market and basically actively trading when necessary within that portfolio, and using relative strength, which is one of our benchmark hallmarks that we like to use in our portfolio, in order to be in the relatively strong sectors of the world, of the investment markets, in order to really help not only protect principal, but also reduce risk, in my opinion. Those are some of the things we are looking at right now. I think it's important that you look at your portfolio. And as always, Resney Wealth Management is available for you if you'd like to call our firm, if you want to interview us about managing your money. Again, we're not a stock brokerage firm. We're not a so-called advisor. We don't sell annuities. We work for you. We are an actual fiduciary. We work under the fiduciary standard. We're an SEC registered investment advisor, fee only, in a money manager capacity. Less than 2%, it's estimated, of advisors are in a fee-only SEC money manager capacity. So if you have somebody currently that's a so-called advisor, if you're paying any form of commission, whether back-end loaded, front-end loaded, or trails, that person is not a money manager. They're not a fiduciary, and chances are you're not getting what you think you are supposed to be getting. Call us. We'd love to help you with your portfolio. We're always available. And as always, make sure you do listen to my Sunday show. I can guarantee it's going to be an excellent show. We've got some hot topics that you're going to want to hear about this Sunday from 10 to noon. Until Sunday show, make sure you have yourself an extremely profitable week.